Hello out there. Welcome to a new edition of Macro Mondays. My name is Mikkel Rosenvold, and I'll try and host this little group of experts through today's show. What a great start we had on a new YouTube channel. We're sending now on or being published on the realvision YouTube channel. We're still coming out as a podcast, so we'll try and manage both. But we are trying to incorporate a little more charts, etc., in the YouTube version. So if you want to see that, it's obviously much easier on YouTube than on a podcast.
Sure.
You can check that out on realvision YouTube site. With me today in the studio, I have you, as usual, Andreas Steno, and you, Mads Eberhardt, our crypto analyst. We're going to be talking a lot on Bitcoin, Mexico, US labor market, and a little sneak peek into next week. So a lot of ground to cover today, guys. Let's jump right into it. Topics for the past week.
Yeah.
Matt, you wrote a great piece on the inflows into Bitcoin. What's going on?
Yeah, so actually what we have seen for especially the past week is that the Bitcoin spot ETF, the US-based ones, they are just massive in their net inflow into these ETFs. So the other day on Tuesday, we saw a total net inflow of nearly 900 million on a single trading session. Which is just massive for these ETFs, and the demand, it just appears like just continuing.
And I mean, to put this into context, I guess it was the second biggest inflow on a single day, right?
Yeah, it was.
And it arrives at the same time as Roaring Kitty being back in the limelight on YouTube. It arrives at the same time as meme stocks seeing inflows, etc. So I guess there is some sort of at least coincidental timing there.
Yeah.
But Mads, also over the past week, you've focused a little bit on Mount Gox, and we before going on air, we had a discussion of how do we actually pronounce this. But I think Mount Gox is what is pronounced like. But Mads, fill us in on this Mount Gox. Why is it important, and why should we care about it from a Bitcoin perspective?
Yeah, so actually Mount Gox was previously the single largest crypto trading venue. So they handled back in 13, 14, they handled around 70% of the total Bitcoin exchange volume. Then in early 2014, they went bankrupt because they were apparently for a few years were hacked. But none of the management or employees discovered that, so they were short around 600,000 Bitcoins, which at that point was something like 300 million worth of Bitcoin, which is, of course, a decent amount, but nowhere near the amount that they are worth now. So the bankruptcy, so the state has just been taking years to handle. But then actually, it is expected that the state will hand out or repay these Bitcoins that are remaining, which is about 141,000. They will hand out these to the creditors this year by latest October 31st. So last week we saw that the state actually moved all these Bitcoins to a single address. And it's critical because the market is scared that as soon as these creditors will be paid these Bitcoins, which is worth about $10 billion now, then they will go to the spot markets and then liquidate them.
Yeah.
Where our opinion is that we do not fear this at all. We know that it would probably not be the whole 131,000 that would be paid out this year. We expect around 90K to be paid out, and then the fact that we don't expect these 90K to be sold on the market is that these are long-term holders because they were pretty much forced to hodl, which is one thing, but also they have been in this market for years, so they probably already have built up a pretty decent amount of wealth due to Bitcoin, and they will probably just stack them in their personal holdings.
I guess it's one of those bankruptcies where you can actually afford to wait.
Yes.
Given the development in the price in the meanwhile. I guess also, like, if you look at the FTX bankruptcy, it will probably end out with a net more than index 100 payment to creditors. It could at least be.
Yeah. So I think the FTX estate have said that they will pay out around 119% of But this is not the crypto value, though. It is the fiat value at the day that they file for bankruptcy.
Okay.
So there, you are still short around 60 to 70% compared to the crypto value that you will have at that point. But still, you get the fiat value back.
Yeah, which is better than nothing.
It is.
And most of us still pay our bills in fiat.
We do.
I'd like to show you the meme of the week, guys. Because a question for you. I'll just get it right here.
Yeah.
What are we seeing here, Andreas?
Well, it's actually one of my own creations, this meme. And it's a picture of the J-Man, Jay Powell, stating that I'm not going to cut interest rates until you peasants stop buying GME calls, obviously referring to the GameStop frenzy we've seen this week again. At the time of recording, my best guess is that the roaring kitty cat is now $1 billion in dollars. I don't know how he exactly plans on exiting this position, given that it's a pretty decent portion of the underlying asset. But in any case, at least on paper, he's a billionaire now.
But I mean, it seems like with huge inflows into Bitcoin and especially GameStop meme stocks, it seems we're looking into excessive risk taking or increased risk taking.
Yeah,
is that because of the rate cuts we've been talking about, or?
Sure. I mean, it's at least interesting that we see this kind of risk-taking during a week where Bank of Canada, the European Central Bank, etc., cut interest rates for the first time in this cycle. I'm starting to get the vibe that a lot of people expect that the Federal Reserve will sort of have to follow this trend via a quote-unquote an insurance cut in September, even though inflation is too hot. So a few takeaways from here. Well, a cutting cycle has commenced across many of the large central banks. That cutting cycle commences while inflation is roughly 3.5%, if you look at it broadly speaking across these countries. So I guess we can now conclude that the 2% inflation target is not something to care too much about anymore. I mean, essentially what we see right now in take the example of Sweden and Canada, two central banks moving very early with that cut, is that we see risk taking, we see a rebound in housing prices and all that. The question is whether it's too early. I don't necessarily have the answer, but my point here is just rate cuts are currently taken as an excuse to add to risk, not the opposite, which is a bit upside down to what we've seen in earlier cutting cycles.
So the message seems to be clear from ECB that it's the next the July meeting is not going to see any cuts. We're waiting until September for further cuts.
Yeah, and then I mean, it seems kind of binary with whether the Federal Reserve will cut interest rates in September as well. To me, they have to move in September if they want to move ahead of the election, or maybe if they want to move ahead of a new president taking office. So it's either September or else it's next year, because I mean, why make the first move just around that election day? That seems odd. So September is clearly in play, and I guess the market is sort of agrees now. But again, here my point is this is risk positive, not vice versa.
So last week we talked about the cut and chill strategy. It's more like a cut in May, almost in May, and go away almost. We're going to wait until the end of the summer to see trends there.
You want to unfuck your shit?
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
Let's move to the weekly Trump soundbite.
Yes,
shall we?
Great state of Arizona, and we're going to tell crooked Joe Biden, you're fired. You're doing a lousy job, the worst job, the worst president in history. Joe, you're fired. And it's all unsustainable.
Joe, you're fired, with some hints back to The Apprentice.
Is it me or does he sound drunk?
A little bit. He does sound older.
But I know he doesn't drink. But
no, he is beginning to sound a little older. I have to say. But again, compared to Joe Biden, that's a whole other discussion. This is perhaps a questionable segue into talking about the U.S. labor market, but it's a way to include Trump as well. let's start perhaps with Mexico, which plays a huge part for the US labor market. We discussed the election in our last show. Claudia Sheinbaum won as we expected. I was personally a little bit surprised to the very negative reaction in markets to her election. How do you view the Mexico case after the election?
I don't think a lot of. I mean, it hasn't really changed at all. If you ask me, new president, same party. But, oh boy, we had that wrong. At least that initial reaction, we had like a 4-5 standard deviation move in the Mexican peso on the back of this. And it was kind of odd to see that, given what's, at least on the surface, seems like a continuation of current stance to a large extent. I'm not a Mexican policy expert, but I mean, at least it's hard to see a big game changer here from a political perspective. So I guess the whole discussion on Mexico can be boiled down to one single question, and that's positioning. If you look at CFTC data, we had like something like 71% of open interest in long Mexican peso. It's been the trade for a couple of years, and I couldn't find anyone on earth being against that trade of being long the Mexican peso versus the US dollar. And I guess the characteristics of that trade remain the same. We're talking about the country that is probably the best equipped to deal with the middleman value add role between the US and China, and all of the trade flows that have been redirected via LATAM, they basically flow through Mexico to a large extent. They value add on top of that, despite not value adding a whole lot, and they earn from it. And the trade balance is basically through the roof in Mexico as a consequence of it. They import cheaper in China than they export to the US, basically. That's a very, very strong structural case for the currency when you build up that trade balance on a monthly basis. So what I'm saying here is that do not care too much about that election. Use this positioning washout to get into the Mexico trade again, I think.
I agree completely as well. One topic that's going to be huge in the US election is the immigration question. It was quite kind of huge in the Mexican election as well, because the remittances from Mexicans living in the US is so huge. I think it's above $65 billion. A lot of Mexicans have been sort of absorbed into the US labor market and has played a huge part in that. We've talked about that over the past months. One of the ways this has happened is by transformation of the US job market, or at least the beginning of that transformation into more of a gig economy. You had some looks on that this week, Andreas. What's going on in the U.S. labor market that enables this?
I mean, by the time of recording, we've had so much labor market data this week, pointing in various directions. I don't think it's easy to find the answer to the labor market right now. But I think the best way to describe it is basically that we are in some sort of low hiring, low firing kind of economy. So the hiring is not really firing on all cylinders, but we don't see any layoffs either.
No.
And I mean, when you look at Challenger data, for example, they basically scrape announcements of layoffs across the economy. We're talking about fewer layoffs than a year ago. That doesn't really rhyme with a recessionary labor market. But on the other hand, job openings recede. The hiring pace is obviously lower than it was a year ago. So it is this odd combination of a lot of sort of hesitancy in both directions. So you don't lay off anyone, but you don't hire anyone either, which is kind of a standstill scenario to a certain extent. But when you take a deep dive into the sectors and the characteristics of the labor market economy right now, what strikes me is that the labor market is held up by what's being labeled as tiny employers by the Bureau of Labor Statistics. So basically employers like you and I, Mikkel.
Mm-hmm.
I mean, companies with, say, 10 employees-ish. And I guess that's a characteristic of the whole labor market we've seen since the pandemic, right?
Absolutely.
The gig economy, I mean, We've been told that by VCs. For example, we've had discussions with VCs over the past few months, and they're annoyed as soon as you talk about being more than 20, 25 employees, right? Why do you want to be that? Yeah. I mean, it's not scalable. Hire them as consultants if you need people. I mean, the labor market has changed for good. And as you can see from the chart we're showing here, chart 4, the birth to death ratio in the non-farm payrolls is still extremely elevated, meaning that a lot of new businesses open relative to closures. And it rhymes with tiny employers, those with, say, 1 to 9 employees, being on the margin the largest net addition to the employment right now. From sort of a momentum perspective, they're posting more than 20% of all jobs in the US economy now. Those very tiny employers, that's a lot. And it's completely out of the ordinary. So something has happened after 2020, basically.
Absolutely. We want to include more listener feedback or viewer feedback in this, and we got one in our inbox that we just want to share. It's from Fox News, a survey from Intelligent.com, which asks employers which of these traits or which of these have you encountered in job interviews with recent college graduates? I'll just read them aloud. Struggling with eye contact, 53% of employers have encountered that. Asked for unreasonable compensation. I know you and I can attest to that, Andreas. No, 50%.
Then maybe I am a part of the 50% then.
No, actually not. I don't think so. The next one, perhaps, Mads, dressed inappropriately, 47%.
Maybe, yeah. Then
used inappropriate language, 27%. You and I could be guilty of that as well, Andreas, in our office. Refused to turn on camera during a virtual interview, 21%. That is definitely so. And my personal favorite. 19% of employers have experienced college graduates having brought a parent to a job interview. 19%, 1 in 5.
But at least you haven't met my parents yet.
Oh, that's true.
Thank God.
That's actually a boom right now. If you go into a job interview and you don't bring your parents, you're already ahead. I mean, that tells you a lot about this. We probably sound like a couple of boomers laughing about this, but
I mean, I think it underpins my point that the labor market is changing.
Absolutely.
And a couple of of short takeaways from this. First of all, I mean, if you're an employer and you think you can communicate with your employees via email, you should consider shutting down your business. That's the first takeaway from this. You need WhatsApp, Slack, whatever, or something else. And the second thing here is that this is a clear example of the labor market turning into a gig economy, I think, because fewer graduates have the skill set that you develop in a larger workplace, right? And this is a clear example of that. So you need to be able to deal with this if you're an employer, especially if you're a tiny employer.
Absolutely. Changing workplace and changing labor market all in all. For the last part of the show, let's turn our attention a bit for the upcoming week that we just entered. We're expecting numbers on liquidity and inflation. We've been running our PCA tool. Andreas, what's your main takeaways?
So we obviously have a big week ahead. Powell takes center stage on Wednesday. And we know that the Federal Reserve will update forecasts and all of that. That's of course of importance for the liquidity outlook. It's of importance for the inflation outlook, and so on and so forth. And when we look at the liquidity outlook right now, you have it in chart 5 here. I think we're, say, between 10 and 12 days from a trough in the liquidity cycle. And the interesting thing here is that we know that the US Treasury will increase their net issuance of T-bills into July. When they issue more T-bills, they will slowly but surely attract the money from the overnight reverse repo facility at the Federal Reserve out of the facility again and into the economy. So that is a very liquidity positive event, and it could be one of the reasons why we already now see some signs in Bitcoin, meme stocks, whatever, of this positive liquidity trend. I still see the liquidity trend being very positive towards year end. Also at Janet Yellen simply needs to empty the Treasury General account ahead of New Year's because of the looming debt ceiling deadline on the other side of New Year's again. So she cannot just keep a lot of dollars on that Treasury account. She will have to spend them. To me, very interesting dynamics in liquidity space to look forward to. And one thing I'd like to bring to your attention as well is that something is cooking in the UK in relation to liquidity as well. We have that on this chart here on the 1 week sterling repo. So basically a facility that adds liquidity to the system. A reverse repo does the opposite. So this repo facility is through the roof. And to me, this is a sign that the UK banking system is telling the Bank of England that, well, you cannot do QT anymore. So if you do QT, we'll just take the money from your repo facility, thereby netting the amounts. So effectively, QT is over in the UK. It's been effectively semi-over for a while, but now it's over. No balance sheet reductions from here. It's kind of the same in the US. The only central bank that still does actual QT is actually the European Central Bank, the only central bank that we were told could not do it. So that's kind of interesting. But point being here that the liquidity environment is actually improving because of backstops, because of these repo facilities ensuring that the liquidity outlook is underpinned no matter whether the central bank wants it or not. So that's good news. In relation to the Federal Reserve on Wednesday, no, there will not be a cut. They will not take a decision on that. September is the meeting to watch. So you need to watch their forecasts, and they will have to revise the inflation forecast up. And in relation to that, I'd like to ask you, Mads, liquidity, obviously positive for your space.
It is, for sure.
But it's a bit more interesting when we talk inflation, right? Because that PCA tool we refer to is like our quant tool on how to assess an asset across a bunch of macro factors. And when you look at inflation versus crypto, it's not that crystal clear whether you should see it as a positive or a negative.
No. So actually our PCA tool tells us that inflation is actually good for crypto. So meaning that every time inflation goes up, then the Bitcoin or other crypto asset prices will follow. Yeah. But then we also know that interest rates are bad, meaning that, which is pretty much, it doesn't really agree, but how we assess it is that in the short term, inflation going up is good for crypto, but then in the long term, it's bad because then interest rates will also naturally follow.
Yeah. But I mean, the package delivered by the Fed on Wednesday, if they increase their inflation forecast, bringing up inflation expectations in a sense, and at the same time communicate that they're still planning on cutting interest rates, to me, perfect signal for the crypto market, right? You get the best of both worlds.
Yeah, that should be the case, and I think it is just like the stars are just aligning right now for the crypto space for a move higher. We have the Bitcoin ETF still seeing very strong inflow. We also have the imminent Ethereum spot ETF, which we expect to launch late June, early July, which is also extremely positive. We have ECB cutting interest rates the other day. So we are looking forward to a second half of this year in crypto, which will be very decent, we think.
Yeah. Interesting. Mikkel, is it time to discuss the portfolio?
Yeah, I think so, absolutely.
Mikkel, I when we look at that portfolio, right, we've taken quite a few profits over the past week. And I think you and I discussed last week whether this Chinese copper story was sort of too extended. Those of you who have followed this show will know that we've talked about the reserves building of copper and a few other metals in China. Over the past week, we received evidence that China has halted the buildup of gold reserves. It seems like this buildup of copper reserves is getting kind of fishy, if you ask me, because it's held at an exchange. Why would you keep that massive pile of copper at an exchange if you actually wanted to build a strategic reserve, unless they want to send us some sort of signal in the West? I don't know. So this whole question on the China bet and the copper bet, it seems a bit exhausted to me. So we took profit in that copper bet a few weeks ago. We actually earned a bit of money on the way down as well. But Mikkel, one thing that really strikes me right now, and I think that will be a major trading theme if you're an EM guy, is that relationship between China and India. Yeah. We see every time India does well, China does poorly in equity markets, and we've had an Indian election.
Absolutely. The result of the Indian election was a disappointment to Modi. He won, obviously. He relatively easily gathered his coalition behind him, so he will continue for another term. But he basically laid this out to be a referendum on Modi. He presented that he had some sort of divine connection to his entry into politics, and really made this about Modi or not. And for him to lose, in quotation marks, such a referendum is obviously bad news for him. He will rule. He'll still have a very clear mandate to rule, but he has lost some of that Superman vibe in Indian politics. And that will make it a little bit harder for him to push through huge reforms. His focus is going to be the Indian job market, creating more jobs, attracting more international investments into the Indian economy, mainly from the West. So I think that's going to be his first the first order in his agenda, basically.
Yeah, I mean, one thing you can note from this is that the correlation between Chinese and Indian equities is negative again. And I guess it's a result of what I call benchmarking. We've seen how investors have decided to leave China, and they've tried to get rid of that EM benchmark position in China. And I mean, it's simple math, right? India is the other big player in that region.
Absolutely. Yeah.
So leaving China means adding to India if you have some sort of EM strategy, right? And I guess that's why we see this negative correlation between the two, that this is not only, I mean, they're not super good friends, these two countries, let's put it like that. But it's also very visible in financial markets. You cannot be positive on both, basically. No.
And
it doesn't really make sense.
No. There's absolutely, they're in fierce competition for these foreign investments. We always talk about them whenever we talk about EM, whenever we talk about Saudi Arabia. But there is a competition going on for the main institutionalized US investment dollar. And that is basically what we're seeing here.
Yeah.
Absolutely.
So, portfolio news, Mikkel. I think the most important thing right now is to have some sort of security against the weak dollar. Also, if the Fed starts leaning towards that quote-unquote insurance cut in September, it would be a mistake to cut rates in the US, I think. But we've seen how other central banks have moved in that direction, despite inflation being at 3.5. You need some inflation protection, basically, either via treasury instruments with an inflation protection or via the crypto space. And I'm not necessarily sure that metals is the place to be for that inflation protection right now, given extreme cluster risks because of that China story, and China halted the gold purchases. They've basically been driving this story. So I wouldn't buy metals. I would buy crypto as an inflation protection right now, or else crystal clear inflation protection instruments such as the inflation protected treasuries. I think those are the main takeaways right now.
Absolutely. To follow all our analysis, you can go to stenoresearch.com.
Yeah.
We post trade alerts as well. You can follow all our thoughts on that, including Mads' analysis on crypto. You can sign up for a free 14-day trial. Just remember that although you're both experts, your advice may be,
sometimes may be good, sometimes may be shit.
We just like to have that little disclaimer in there.
Yeah, for those of you watching this for the first time, this is Gennaro Gattuso, Italian footballer, at the time, I think, manager of Sion FC in Switzerland. And on a presser, he basically said, sometimes we're good, sometimes we're shit. And that's exactly the same you get here. Sometimes we're good, sometimes we're shit.
That's the way
but at least we try to entertain you. And after a week of a lot of comments in the comment section, boring, we need more charts, we need more memes, we need more weird takeaways. I hope you like what you saw.
Otherwise, let us know. We're here to please you. So, Mads, thank you for joining.
Thank you.
Thank you as always, Andreas. My name is Mikkel Rosenvold. We'll see you next week.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.